Next, I would like to cover an overview of our investment philosophy. We based our investment selection on an evaluation of risk in the market, not long-term mathematical averages. Therefore, we attempt to be dynamic with our asset mix selection rather than static over time within client accounts. We do so to attempt to achieve more sensitivity to market risk and improve the risk-reward ratio in these times of uncertainty. Our main strategy uses seasons as an analogy to better comprehend and identify which investment cycle we are currently in and how to more appropriately allocate investment resources. In the spring season, around the turn of the 20th century, in the 1950s and early 60s, employment and consumer confidence increased along with inflation. Stocks rose from low levels and we had the start of early debt buildup. During what we consider the summer phase, we see the price of real estate soar with an upward trend in interest rates and gold and commodities, with stocks making little to no progress and the capital goods sector overbuilding. The most applicable periods of time to this phase is the early 1900s and the 1960s and 70s. Next comes the autumn cycle, which most relevant to the 1920s and the 1980s and 90s. During this season we see bond prices rise, interest rates fall, the rate of inflation drops fast, and the debt rises to unsustainable levels. In turn, the stock market booms. The final season in our cycle is the winter cycle. During this time we see currency crisis, low consumer confidence, bankruptcy, high unemployment, and a run from paper money to gold and other commodities. Does this sound familiar? It is our opinion that we are currently in the middle of a winter cycle, similar to the late 1920s, 1930s, and early 1940s. We focus on the belief that not all bear and bull markets are the same, and that your current investment philosophy should be based on the knowledge of which investment environment you are in. Therefore, investment decisions should be based upon the risk within cycles, not math that is all-encompassing over 100 or more years of historical market data. Let's take a closer look here at a graph that represents the comparison to scale of the 1990s and the 1920s. Next here we see a comparison to the 1930s and to the 2000s. When drawn to scale, the comparable seasonal periods in both examples tend to behave similarly. As we go back to looking at the long-term history of the Dow Jones, I want to point out one of the most important things to understand in this presentation. If you were 30 years old and started your investment time period during this cycle of the market, you would fall significantly short of the 9% long-term average by sticking to the buy and hold strategy that has been made so popular by our industry. Yet, if you were 30 years old and just happened to start investing at this point in the market, you would significantly outperform the long-term average return of 9%. What is the most important message here? Long-term buy and hold strategies can be vibrant at certain periods in our investment history, and will be most likely again at some point in the future. The current investment environment we are in, however, the buy and hold long-term strategy is not going to be the most optimal way of investing, and particularly for those nearing retirement or in retirement, the risk your portfolio is going to experience is going to be unnecessarily high and potentially detrimental. Let's now take a look at the last 5 years of the S&P 500 and Dow Jones as of October 5, 2011 and March 7, 2012. The overall return, up until October 5th, was negative 10% for the Dow Jones and negative 18% for the S&P 500. Staggering, right? Next, let's look at the same sample size merely 4 months later. It is a completely different picture. My goal in showing you these two graphs is for you to become aware that our current market environment is very volatile, and how having the goal of reducing risk over the long term is the best way for sustainable growth. Naturally, then, I always ask the question, was the 15% or so the market increased last year or the 5-year performance of the market more important to a client portfolio? Logically, the answer is the latter. To help you better understand in another way how our investment strategies operate in this market environment, I have created a dice game. The rules of this game are that you must roll 2 dice every turn, and if it is a 7 or greater, you win $100. But if it is less than 7, you lose $100. There will be a total of 5 rolls, and your chance of winning is always 55%, or 6 out of the 11 possible roll combinations. Your first roll is an 8, so you win $100. You must roll every turn, so let's move on to a second roll. A 3. Unfortunately, you lose $100 on this roll. 10 gives you another $100. Another 10 gives you a total of $200. And your final roll is a 4, yielding you a total earnings for Game 1 of $100. Game 1 is a representation of how modern portfolio theory, the technical term for the long-term buy and hold strategy, works. The significant majority of the investment community bases its investment philosophy on this theory, from small and large corporate 401k plans to pension plans and insurance investment products. With that in mind, let's take a look at the characteristics of Game 1 and analyze what happened. We assumed that your chance of winning every roll was 6 out of 11, or if by rolling a 7, 8, 9, 10, 11, or 12, you would win $100. If not, you lost $100. By rolling every roll, you had a long-term winning average that didn't deviate. Therefore, the money you earned was done so by leveraging this winning percentage over time. This strategy promotes an overall higher potential for longer streaks of wins and losses when compared to what I will show you next. Now let's play the same game but base our strategy using Sampson Investment Management's investment philosophy. As a reminder, you will still win $100 if you roll a 7 or higher and lose $100 if you roll under a 7. But this time, you will have the option each turn whether or not to roll. Let's also assume that you will roll whenever your chances of winning are greater than 55%, and you will not roll if your chances of winning are less than 55%. Your first roll has a 70% probability of winning, therefore you choose to roll. Congratulations, it is an 8, you win $100. Now on to roll number 2. Your chances of winning are only 20% this time, therefore you choose to sit this one out. Lucky you did, because the total for the roll is 3, and you avoided losing $100 this turn. Roll 3 gives you an 80% chance of winning, so you roll. It is a 10, earning you another $100. On to our fourth roll. You have a 75% chance of winning this round, so you decide to roll. Even with a higher winning potential, anything less than 100% probability will still leave you with a chance of losing. Unfortunately, the dice total 5, causing you to lose $100. Your final roll gives you an 80% probability of winning, so you decide to roll. It was a good decision. A total of 7 earns you another $100, which gives you a grand total for game number 2 of $200. Let's take some time now and reflect on game number 2. The assumed chance of winning each roll was analyzed, and an intelligent decision was made whether or not to participate based on the level of risk involved. Avoiding rolls with higher levels of risk resulted in a better overall performance for the game. And by having knowledge of the level of risk involved with each roll, we also reduced the likelihood for prolonged streaks of wins and losses. This is especially valuable in a volatile market environment such as the one we are currently in. Here's another way of looking at how Sampson makes investment decisions. Listed are 3 different clients: Client A, Client B, and Client C. Each client starts out with $100,000 at the beginning of year 1, and in the parentheses is the specific return for that year. Listed at the bottom is a total return for each client from the start until the end of year 5. What I'd like you to notice is that Client A and Client B both outperform Client C in all years except for year number 2. Yet Client C's overall performance is far better than both Client A and Client B. Why has this happened? The key to focus on is in year 2. Significant outperformance while the market is in a downward direction is vital to healthy long-term performance for a portfolio. It is very tempting and easy to get wrapped up in what the media feeds the public with regards to investment return information. This quarter the market has returned 15%, one newscaster on CNBC might say, or gold has surged 50% in the last year, another might say. But how relevant is this to the overall performance of a client portfolio? Well, Yes, investment in return is very important, but the scope in which you perceive performance is equally, if not more important. During these volatile markets, Sampson Investment Management strives to reduce risk while outperforming over the long term. Fortunately, our strategies have been able to accomplish this in a time where most of the industry does not have an answer to what clients are looking for. Although it is retraining for most people of how to think about investments, once they understand and embrace what we are doing, they begin to feel much more comfortable in a time of investment uncertainty. They also ask why, if it is a strategy that is working in this market environment, more investment professionals are not investing for clients in this way. There are two answers to that question. For a long time, the professional investment community has, very successfully, based their investment strategies on a long-term buy and hold strategy, coined with the official name modern portfolio theory. A lot of infrastructure for the investment community is built around modern portfolio theory, thus making it more difficult to deviate from what has a long time been the most popular way to operate. Remember this chart I showed you outlining the different market cycles over a long period of time? When facing a winter investment environment such as the one we are in now, to find success, people need access to new ways of thinking that are better able to identify risks in the market and in turn help more successfully navigate their way to financial freedom. For those of you who are a bit more technical, here is another component of how Sampson's strategies analyze the markets. According to the black curve in this graph, over approximately the latter half of the 20th century, the least risk asset mix you could have employed was approximately 80% bonds and 20% stocks. I'm sure a lot of you have heard an investment professional tell you at some point in time that you should be allocated to 60% stocks and 40% bonds if you are a moderate risk level investor. This analysis is what derives this optimal mixture within our industry. The other curved lines on this graph represent the changing nature of the best optimal asset mix of bonds and stocks broken down by decade. As you can see, each decade brings about a different optimal outperforming mix. At Sampson, our core investment philosophy is to leverage strategies that analyze the risk in the market and attempt to take advantage of the dynamic changes in these optimal ratios. Here is an illustration of how our risk-based strategies have performed over the last 6 years. The dark red line represents the S&P 500, the green line represents a benchmark mix of 60% stocks and 40% bonds, typically allocated for a moderate risk level investor, and the blue line represents the moderate risk-based strategy we use at Sampson. It is obvious to visually see the outperformance over a longer period of time, but what might surprise you is that this strategy has performed very similar to client C in this example that I shared with you previously. More importantly, though, is to remember the two components that are relevant when analyzing the performance of your portfolio. Yes, percentage return is important, but what is equally, if not more important, is to understand the risk you took to achieve this performance. Media outlets and education do a poor job outlining this simple concept, yet it is vital to understand when analyzing the performance of a portfolio. What this risk-based investment strategy has been able to do in this market environment is something every fund strives for but few achieve: better returns with less risk. As you can see in this scattergram, the moderate strategy represented by the blue diamond not only outperformed the index in optimal long-term buy and hold mix for a moderate investor, but it also achieved it with significantly less risk. I would like for you to take a second and consider asking yourself this. Do you personally know how much risk you are taking to achieve your return in your investment portfolio? If not, it would be a good thing to ask your current investment advisor or seek out yourself. If you are in retirement or nearing retirement, you might be putting your portfolio at significantly more risk than you are aware of. This can potentially be a huge danger to your future quality of life and ability to achieve the financial goals you have set out for yourself and your family. Here is an illustration of the real activity within the moderate strategy to better show you how risk-based investing is dynamic rather than static. If you look at the snapshot of activity beginning in 2006 through the middle of 2010, you can see how the strategy changes its optimal mix of asset classes to match the risk in the market. The darker and lighter yellow colors represent low-risk investments that seek capital preservation. As you can see, from late 2008 and into 2009, the strategy took a major shift to a much higher allocation into the investments represented by the shades of yellow. And as we progressed through 2009 and the market became less risky, the strategy started to invest in investments more likely to generate higher returns. What you should conclude from this illustration is that the strategy is actively responsive to changing risk in the market, with the intention of producing the best overall return given a 3 to 5 year period of time.